Morning, everyone. I think we may as well make a start. For those who don't know me, my name's Gordon Richards. I am one of the directors in our Perth office. I basically work in the commercial services division. There's two directors, so Glenn Waldock and myself, basically head up that division. And we work with basically any business really, so anything from transport companies to pharmacies to mining services. There's a wide range of clients that we deal with. Thanks for joining our webinar this morning, where we're going to go through basically buying or selling a business, and what to think about, what things we look at, what things you guys should consider. The plan is to try and talk around the slides as much as I can. I don't have too many slides. It's one of the topics where it's good to basically discuss them in depth. I will try and break every now and then for a few questions. The way the webinar is set up is I don't think everyone can talk freely. Just I think you're all muted, so maybe if you've got a question, if you just raise your hand, there should be a little icon on the bottom of your screen saying raise hand, and that'll let me know who's got a question, and we can chat then basically. If you're not comfortable doing that, there's always the Q&A panel as well, so feel free to type questions in that Q&A panel. Okay. So I will make a start and share my screen. So hopefully everyone can see that okay. Going through buying or selling a business, what to consider. The length of things to consider is large. Every business is different. Everything that you need to consider from one business to another is different. So hence our next disclaimer, particularly with this topic itself, there's so many different things that can and will come up. So if you are looking at something or you're thinking about putting an offer in a business or potentially selling your business, please reach out to someone here at Byfields. So what we're going to cover, so we'll go through effectively the process. So what the general process is when buying or selling a business. Okay, so as I said, they all differ, but we'll go through roughly my experience of what we do, what we look at, and the process itself. We'll talk about some structuring options. Again, what suits one person doesn't necessarily suit another. But again, we'll think about the things or talk about the things that we generally consider when structuring, and what you guys and what the clients need to think about when deciding on what structure to set up, and also how to structure a business purchase or sale for that matter. We'll talk about tax considerations. So tax, as we know, is inevitable, but there's ways in which we can minimize the tax, to put it politely, and that's both on the actual running of the business itself, so throughout the journey, year by year, how we effectively minimize the tax that we pay or defer it, and also on sale as well. Okay, because obviously we want to make sure that we maximize our take-home pay, just to ensure we get the most out of selling a business. That's the fourth point down there, buying or selling shares versus assets. So this is an important thing to think about when you are buying or selling a business. So there's different ways in which it can be structured. So when I say obviously buying or selling shares is pretty straightforward, as well as self-explanatory rather. If you we'll talk about buying in this instance. So if you identify a business that you're interested in, and you are keen to make an offer, there's two options really. There's option A, which is buying the shares, where you and obviously that can only happen if it's a company or a unit trust for that matter. So it's either shares and or units, where you effectively go and you buy the shares off of the current owners. So you pick that entity up and you take it and you run that whole entity. Okay, so bank accounts, contracts, vendor numbers, all those sorts of things. Versus option 2, where you buy the business outside or out of that entity. So you set up your own entity and you buy the business, so stock, plant, equipment, goodwill, and you take that business and put it in your own structure and keep running. Okay, so pros and cons with both option and different things that we think about. We will go through preparing a business for sale. So this is obviously when you are looking at selling and what things you need to start thinking about prior to putting your business up for sale. And that generally is a fairly or can be a fairly lengthy process if you want to do it properly. It's, you know, we generally recommend not turning around and saying, I've had enough, I want to sell my business tomorrow, because there's lots of things that you need to get in order and basically prepare the business so that you can maximize your proceeds and maximize the sale price. In that, we will also go through roughly the valuation stroke appraisal process. So how we look at a business and how we value a business. That is a fairly in-depth topic in itself. So I'm just going to touch on it high level. But yeah, it will give you an idea on what we look at when we're valuing or appraising a business. We're going to touch on the due diligence process. So due diligence is where you identify a business that you would like to purchase, or you're selling your business. And as a buyer, you would look at the business itself and go through and dot I's and cross T's to make sure that you are buying or that you're paying for something worth paying for. So it's basically dotting I's and crossing T's, and it's just making sure that what the seller says is happening is actually happening. Okay, and there's a list as long as my arm in terms of what things we look at or what things we can look at. Don't necessarily always look through all of them. It's inevitably, whatever you as a buyer would like to look at and what you would like to trust the seller on. But we'll run through that. And yeah, we'll go through the negotiation process and the things that we look at and what often come up in that negotiation stage. And then there's a few other things that we'll touch on as well. So I suppose initially we'll just go through broadly the process that we generally go through when buying or selling a business. Obviously, the steps involved vary on a case-by-case basis, and also if you're the buyer or if you're the seller. Okay, so generally they are consistent, but obviously if you are the seller, you're not necessarily going to go through that third last point in terms of doing a due diligence. You'll have to gather a lot of the info together, but you're not going to go through and dot I's. Okay, so really, yeah, the start of the whole process is basically identifying a business that you as a buyer are interested in, or obviously if you're selling. Okay, so we're not going to sit here and say, well, you should be interested. Well, we could sit and say that this is a good business because it's really profitable and so on, but inevitably you as the buyer need to be confident in what that business is doing and its future, basically. Okay, so it's very early stages where you will identify a business that you are keen on and that you're interested in, and that you might see have various opportunities moving forward. I've had some clients who have bought businesses that are really on the downturn, or look like they're on the downturn. And sometimes you look at it and you're like, well, why are you buying that? It's sort of not making much money. It's declining. But once you look into it a bit further, there's opportunities that can come up as well. So just because on face value a business is declining doesn't necessarily mean that it's not a good buy. Us as accountants, obviously the first thing that we're going to look at is the actual figures themselves. And then, as I said, we'll go through how we do that and roughly the processes that we follow. But if you're in the game, so if it's a good add-on to your current business, or it does something that you're interested in, you might identify other areas that are opportunities, basically. I've got one client that I remember that did that same thing, bought a business that was declining. It did have some patents in it, which us as accountants obviously wouldn't realize the value of those patents and the opportunity. And the clients turned that business around, and it's gone from being a smallish business to a multi-million-dollar business. So lots of different things that you need to think about when identifying that business, and not all of them are financial. Okay. Once you've identified the business and you are interested, we might have some initial discussions with the seller and do a bit of a preliminary review of the business itself. So as I touched on at the start, we would generally look at some profit figures and some financials to do a bit of a preliminary review on whether what they are asking for is worth it, but also whether that business has a viability moving forward. Okay, so generally the seller will, the process varies. I was going to say generally the seller will be a little bit reluctant to give you too much info until you're actually very, very keen and interested. I suppose the actual amount of disclosure generally varies depending on whether you are going directly to the seller themselves, or a seller is going through a broker. You'll find generally with a broker, they'll do effectively a memorandum of the business. So all the opportunities, all the weaknesses, probably less so weaknesses, but all the pluses of the business, and will give you some information on it all. Whereas if you're buying directly from an individual, they will generally have pretty informal discussions with you. They might get their accountant to forward you some historical financials and a bit of other info. But until you're very keen and you show that interest, they are sometimes a little bit reluctant to give you info because they probably don't like tire kickers as such. Once you are interested and they can see that, quite often they'll get you to sign a confidentiality agreement, or get us to sign them, where we basically just saying we're not going to share info to the wider market. As I'm sure you can appreciate, there's quite a bit of information in those sorts of figures and the stuff that they provide that if it got out to their competitors would mean that it's not ideal. And also you would often find that businesses that are selling are quite keen to keep that quiet. Okay, so there's a number of reasons for that. Obviously, if their clients find out that they're selling and they get an opportunity elsewhere, they're probably more likely to take that opportunity as opposed to stick with a business that is selling, and they may move that relationship elsewhere. Similarly with employees, if you've got an employee that is really close to the owner and finds out that the owner's selling, less likely to stay. Okay, so signing those confidentiality agreements is quite common, and something that we shouldn't really shy away from, because it is understandable. There are occasions where once you're further down that line, so once you've had discussions with the owners, you've potentially met with them a few times, you've looked through the actual through the financials, and you're satisfied on a dollar value that you're willing to offer. There's quite a few occasions where they'll get you to go, or you may want to request a site visit. So obviously, depending on what type of business it is, they might have a commercial property where they run their operations from, or it might be on a client site to see how things are running. Because, as I said at the start, it's not just the financial side of things. There's operations, processes, systems that you need to be satisfied with as a buyer. And to be able to enable you to do so, it might mean that you need to go and visit site. Sometimes, as I said, the buyer or the sellers can be a little bit tricky or picky with that sort of thing, because they don't really want people finding out. But other times they're open to it. So I think as a buyer, you should be very keen and should be pushing to look at that side of things as well. There should only be very few circumstances where you shouldn't be requesting to go to site. So once you've had those initial discussions, you've looked through all the relevant documents and basically satisfied yourself on the value of the business and the opportunity of the business, the next step is to put an offer in. Okay, so generally there will be an asking price on the business, same as when you're buying and selling property. They'll have a range, or potentially have a range or a starting point, and you effectively need to put your offer in. Exactly the same as property. I wouldn't put your offer in at the high end unless you're really keen to get it, or if you've got other competitors that are offering similar amounts, or offering amounts as well. You generally want to start lower and work upwards, or meet somewhere in the middle. As part of that offer as well, we need to think of all the conditions that you want to put on that offer as well. So it's not just a case of identifying a dollar figure. You need to put a number of different conditions in there that you want to be met. Okay, you want the seller to meet, and that could be these conditions precedent, which is things that need to be satisfied before the business is sold or before settlement, or conditions subsequent, which is things that have to happen after the settlement itself. Okay, so examples are of conditions that you need to meet. All the relevant approvals are made. So again, this is probably more from a seller's point of view, or a buyer's point of view, sorry. Like, again, if it's a small one-man band, it's not, you don't need to go to the board and seek approval to buy the business. Whereas if it's a larger business, you need to seek board approval, get all your relevant approvals to buy the business. So it's internal approvals, which is internal to the company, and external, which is generally things like government bodies and so on. So that doesn't come up too often in the cases that we look at. But I had a client that sold to an international buyer a couple of years ago, and they had to seek Foreign Investment Review Board approval. So when you've got investors coming in from overseas, they need to get approval to invest in Australia. So just again, ticking boxes. Another vital condition that you need to be doing as a buyer is removing, or getting the seller to remove, all the relevant securities. Okay, so there will often be different levels of security that are placed on a business. So you might have certain equipment financiers that will put a security over the business on the PPSR, the Personal Properties Securities Register. Okay, or a bank will put a GSA, a General Security Agreement, over the entire business itself. Okay, so you don't want to pick up a business and buy it whilst it's got security on it, because then ultimately you're potentially liable to that bank, even though it's not your borrowing. Okay, so it's important to do the relevant searches and so on, which we'll go through in the due diligence process, and make sure that as part of the conditions that the seller remove all those registrations, which can be really easy and it can take a lot of time. Okay, I've had clients where they've been selling and their suppliers might put a security on them, where they've got a floating charge over the business whilst that supplier's providing stock and that. And sometimes those suppliers are pretty reluctant to remove that security until they are 150% satisfied that all of the stock is paid for, there's no debt owing, everything. So, it's not something that we would recommend looking at in the last couple of weeks or last couple of days of prior to settlement. You want to get onto that pretty early. One of the other conditions that we'll generally look at is and again, this is probably more the case where you're buying the shares of a company or units. It's just making sure the balance sheet is clean. So you'll often have inter-entity loans from a previous buyer or previous owner, making sure that they clear those loans, because you don't want to pick their company up and you then suddenly realize by looking at the balance sheet you owe one of the other entities and they call on that loan. So just cleaning up the balance sheet, clearing loans, all those sorts of things. Property leases. So if you've got a business that is leasing a property from a third party, you want to make sure that the actual offer is subject to that property lease being assigned to you. Okay, because you don't want to have to buy a business and then the landlord said, no, I'm not going into business, I'm not leasing my property to you. I was leasing it to Joe Bloggs, the previous owner. Or they may turn around and say, okay, well, that lease is finished, I'm going to start a new lease and charge you twice the rent. Okay, so there's a couple of things. Obviously, the assignment is vital. You want to make sure that lease is assigned. But also you want to make sure that the term of the lease and the conditions of the lease are satisfactory. Okay, so again, I had a client that was buying a business, had a lease in place. The lease was the landlord was happy enough to assign the lease, but the lease expired in 2 months' time. Again, you don't want to go and buy a business, pay hundreds of thousands of dollars for the business, and then 2 months later, the landlord says, okay, we'll see you later, I'm kicking you out. And then you've got nowhere to operate the business from. So, if that's the case, you want to go into negotiations with the landlord and firstly get them to assign the lease, but also get them to vary it, to extend it, so you're not sitting without a premises. Employees, again, you want to, I've seen in certain contracts that it's conditional upon the existing employees or a proportion of the existing employees agreeing to come across to the new buyer and to continue working with that new buyer. There will often be a general clause saying a majority of employees will stay with the buyer, whereas other times it's geared more towards a particular individual. Okay. So again, and this comes down to that review, that early review is identifying which employees are vital in the business and trying to protect yourself against those. Once you've got all those conditions, there's obviously a fair bit of negotiation for it, because as a buyer, you want to protect yourself as much as possible. So you want to put as much in there as you can. Whereas a seller, you don't necessarily want to be hamstrung too much by that offer and by those conditions. some things that you'll be that will be in there more often than not, and that you're bound by. But other things you can push back and say, no, we're not going to put that in there, and so on. It obviously largely depends, as with anything really, is how keen you are to get the business, and whether there's other potential buyers around as well. How desperate the seller is to sell will dictate what's in those negotiations and how they generally operate. Another one that I've just remembered about, which is very common these days and is often forgotten about, and again, it's to do with employees, is you as a buyer might put in there that the seller is to pay you an amount equivalent to the employee's annual leave. Okay, so if you're taking over those employees, there will either be they will be paid out by the previous owner. Okay, so they'll lose all of their leave entitlements, or that leave will transfer over to you as the buyer. Okay, if that's the case, you're effectively inheriting a liability from a previous owner. So you'll start the business from day one, and you may have $100,000, $200,000, $500,000 worth of annual leave and long service leave owing to your employees, but they've done nothing for you as such. So there's often clauses in the contracts that says on settlement, the seller is to pay the buyer an amount equivalent to 100% of the annual leave owing to employees, or sometimes it's 75%, sometimes it's less. And again, it just depends on negotiations. And that will generally cover annual leave, long service leave, and sick leave. Okay, so even though there's no guarantee that those employees are going to take sick leave, it's still potentially a liability. And so that's where you would negotiate and say, well, as a seller, you would negotiate and say, well, there's no guarantee that the employees are going to take that leave, so we're only going to pay you 50% of that leave balance. Okay, and that will all happen through settlement. So if you're selling the business for $1 million and you've agreed to pay $100,000 to the buyer for that leave, it will just be withheld from the sale price. So instead of getting $1 million, you'll just get 900, being the million less the 100,000 of leave. Once you've gone through and put your offer forward and done all the backwards and forwards with the negotiations and everything, the seller will accept the offer, hopefully accept the offer. And a lot of the time throughout those negotiations, you know what they're after, they know what you're after. So you generally agree on things as much as you can throughout the whole process. Once they accept the offer, you then move on to the due diligence and the conditions precedent. Okay, so that's going through ticking all the boxes and making sure everything's all sorted prior to settlement. You'll then have a settlement, which is a fixed date at which the ownership transfers over. So if you're buying shares, it's easy. It's today's date being the 30th of October. That's when the share sale happens. That's when old directors resign, new directors are appointed, ASIC gets notified of the share transfer, and so on. Whereas as a business sale, it's a bit different, where there's just a fixed line where anything prior to that was with them, with the seller, anything post is the buyer. And the same with a property sale. There is a lot of adjustments on the sale price. So often settlement agents will get involved, and they'll work out everything from rent that's been paid but not for the full month. Obviously, deduct the broker's fees and their fees and the leave adjustments, and working capital and debt adjustments and all the ins and outs to reach that final proceeds payable, and then pay that across to the seller, and then we move on. Okay. There are a few, I've got conditions subsequent there. There's not too many a lot of the time. Probably the more common ones, obviously updating ASIC, making sure ASIC's aware of the change if it is a share sale. There's quite often a seller's assistance clause that they need to meet. So, the buyer might turn around to the seller and say, well, you need to give me a month's handover. And that could be paid or unpaid. And effectively, the seller just needs to stay in the business for that month, or as long as the buyer wants, or they agree on, to hand over to the business. Show them how it's done, show them what they do day to day, introduce them to customers, which may have happened before, but if it hasn't, definitely do it afterwards. And yeah, just tick a few boxes after sale, and then we move forward. So with structuring, actually, I might just break quickly. I don't think we've got any questions, but yeah, just a reminder, if you do have any questions, just either put your hand up. I think there's a little box at the bottom of the screen saying raise hand, or just pop it in the Q&A box. But I don't think there's anything there at this stage. No, all good. Structuring, yeah, it's basically a whole presentation on its own. Yeah, what suits one person will be very different for another. It's very much dependent on your personal circumstances and your existing businesses, your existing assets, how the business is going to operate, how it's going to interact with other entities. So lots of different considerations there. The main ones that we think about are asset protection. So basically protecting your personal assets against potential debts of the business. Okay, so the entity that's got the most asset protection is a company. Okay, so that's a separate legal entity where you as an individual are generally removed from the operations of the business. Okay, so it's a separate legal entity. It enters into its own contracts. It's not entering into contracts on your behalf or things like that. So, and the benefit with that is if that company falls over, the debts are generally limited to whatever is in that company. Okay, they can't always come and chase you personally, which means that your personal house is up for grabs or things like that. There's a couple of exceptions to that, and it mainly or does stem down to whether you are acting as a director of the company or not. Okay, so if you've given directors guarantees, which is where you are personally guaranteeing something on behalf of the company, which they are more and more common at the moment, and I'll be honest, you'll be hard to borrow any money, whether it's from a bank or a supplier or credit with a supplier, without having to give a director's guarantee. So just be mindful of what director's guarantees you give, and probably keep a list of them. We've got a lot of clients who have no idea who they've given director's guarantees to and what's out there. So just be diligent with those director's guarantees and keep a list. The other exception is with the ATO. So the ATO have things called director penalty notices, where if you as a director of a company, or if the company is not paying their debts, their ATO debts, which is GST, pay-as-you-go withholding, and super guarantee, the ATO can chase the directors personally for those funds. Okay. As I said, it's a whole nother topic in itself, so I won't go into too much detail, but yeah, companies generally the most safe from an asset protection point of view, but there's other exceptions as well, and other things that we need to think about. Okay. Other options are trusts, partnerships, sole trader. Partnerships and sole trader we generally steer away from. They probably aren't great from an asset protection and aren't great from tax minimization, so we steer away from those. Companies are probably the most common, but trusts are reasonably common as well. Another thing that we look at with structuring is tax minimization. So that's, and I'll touch on tax considerations. I think it's the next slide. But ultimately, it's how to minimize tax along the way. So on profits as you go, but also the tax on sale as well, because depending on what structure you're in will dictate how easy it is to minimize the tax. Succession is important. So if you are going into business with an adult son or daughter, you know, how easy is it to pass that business down to the next generation? Some entities are easier than others, so we need to look at that. Flexibility, again, some structures are more flexible than others, and that's in terms of profit, entering into contracts, a whole bunch of different options in terms of how flexible the structure is in terms of what we do with it, where we go, those sorts of things. So it's probably not a huge consideration, but we do think about it. And then that last one is important as well, which is often forgotten about. So certain banks, customers, suppliers will only deal with one particular type of entity. So, which is a company really. So a good example is mining. In the mining game, you find that the big mining companies will only deal with you if you're a company. Okay, that's just because it's from their point of view, it's transparent. They know who they're dealing with because they can do a search and work it out. There's less risk from their side of things. So again, just think about your likely customer base. Are you going to be dealing mostly with the mines or international companies? Again, I've got another client that does a lot of work with WHO, World Health Organization, and he had one option, and that was a company. They wouldn't deal with him unless he had a company. So just something to think about, which is often forgotten about. Any more questions? No. Tax considerations. So as I said, being accountants, is pretty much everything we think about is tax, or almost everything we think about. So how do we minimize the tax that we're paying? How do we defer it? And massage the tax. So it's always important. So that's on, as I said, tax on profits. So as you're going, certain entities will give you the benefit of limiting the tax. So obviously a company is limited to 25%. Unless you turn over more than 50 million, then it's 30%. So it's a flat rate of tax. But if it ends up in your personal name, it is up to 47%. So that can, if you're earning big profits and you're not structured right, that hurts, and it often limits what the business can do moving forward. If you having to use a chunk of your earnings to pay for tax, it's hard. Okay. Similarly on drawings side of things. So if you're pulling money out of the business, how do we minimize the tax payable on that? When is that tax paid? Which is the timing side of things. So like a prime example is company versus trust. Okay. So and this is the actual tax on profit. Sorry. So a company is just flat 25% of whatever the profit is. Okay. You only pay up to your marginal rate, up to your higher rate of potentially 47%, where you pull the money out of the company. Okay, so that's where this impact on working capital comes into play. So yeah, company, you earn $1 million. The company pays 250 grand on that, and that's it. It stays. You can keep the working capital in the business to keep operating. Whereas if you're in a trust, and you earn $1 million, potentially your tax is, high 300s, $400,000 because of the sliding scale, which means that you're going to have to pull, or potentially have to pull, money out of that trust to pay your personal tax bill, which means that there's potentially not enough money to fund the operations of the business, and have a big impact on working capital as well. Okay. And yeah, the timing side of things is important. When is the tax paid? Is it paid on when it's earned, as is the case in a trust, versus in a company? So I'm talking about individual tax here, sorry. So is it paid when it's earned, so trust, versus when it's actually physically drawn from the entity, which it would be in a company? So there's a few things that we need to think about from a tax side of things. Okay, and as I said, that's to do with structuring and ongoing side of things. I've got the tax on the sale there, so I'll touch on it in a second, but the tax payable on a sale of a business is very important to consider, because there's ways that we can minimize it, there's ways that we can eliminate it, and get rid of it entirely. So yeah, again, just something that we think about along the way, as we're approaching sale, and also obviously immediately prior to sale as well. No questions. Everyone's quiet this morning. Next slide I'm going to go through is different ways to structure a business sale or purchase. So as I touched on at the start, there's really two ways in which we can structure the business. The first is where you buy the shares in an existing company. Okay, so you identify a business that is for sale, and you want that whatever is in that existing company. Okay, which may be contracts is a big thing. So if a business has existing long-term contracts with their clients, you don't want to have to go through the whole process of getting those contracts assigned from ABC Proprietary Limited to your company. Okay, so because sometimes the clients themselves don't necessarily want to assign those contracts across. Same with things like vendor numbers as well. If you've got a company that's got a vendor number with a mining company, so largely mining companies will often issue their suppliers these vendor numbers, which sometimes they're quite valuable. Okay, so yeah, option A is buying the shares, and option B is buying the assets of the business. So buying the business itself and picking it up from ABC Proprietary Limited and putting it in your company. Okay, the assets are generally stock, plant and equipment, and goodwill. Okay, so those three things are picked up and moved across. Often things like employees and a bit of working capital and stuff will come with it, but you're basically taking the business out of that existing company, and putting it in your new company. Okay. From a seller's point of view, again, there's pros and cons. Obviously, if you have an existing company and the buyer is buying that company from you, it goes with all the cash and everything in it. Okay, so you might have a case where you decide with the buyer that you're going to pull 100% of the funds out of that company, which comes with tax. On the flip side, you might have loans in that company that have, you might have had another entity that's been funding the working capital of that trading business. Now you need to figure out, okay, well, how do we clean up the balance sheet? Because the buyer is not going to want these loans. So yeah, pros and cons with both options. Yeah, it's very much a case by case. It's not a one size fits all. So I urge you, when you're looking at buying or selling, touch base with us on those. Okay. So just working through the pros and cons. So when you're buying or selling a business, so that's where you pick the business up, so stock, plant, equipment, and goodwill, and put it in your own entity. Pros are, it's simple. It's, it is what it is. You know what you're buying. You can cite the stock, you can cite the plant and equipment. Goodwill, you've got some, we've got some processes that we follow that can ultimately identify it, which I'll touch on in a second. Yeah, it's straightforward. Tax deductibility. So when you're buying a business, say for example, you identify the value or the business price and you agree on $1 million for the value, that is more often than not broken up into the different components: stock, plant, equipment, and goodwill. Excuse me. Your stock is tax deductible straight away. So if $500,000 of that purchase price is stock, straight away you get a tax deduction for that. Plant and equipment, as we know, unless each individual asset is less than 20 grand, because of that instant asset write-off for temporary full expenses now severely reduced. But generally, plant and equipment you would depreciate. Goodwill you have to capitalize onto your balance sheet, so you don't get a deduction for the goodwill. But as you can see, if you're buying a business for $1 million, generally a large portion of that will be tax deductible. Whereas if it's if you're paying $1 million for shares, you don't get a tax deduction for that. The only time that is going to benefit you is if you sell those shares at a later date. Cons. So for buying a business, that first one's pretty minor, but probably a little bit more, or potentially a bit more costly. Like you've got to set up your own structure, and so on. You don't just walk. It's not walk in, walk out. So you've got to pay for your own setup of everything. As I mentioned at the start, if you're buying a business, you've got to make sure that you enter into your own new contracts, or you assign those existing contracts over to your entity. Same with vendor numbers as well. Okay. So you've just got to be conscious about that. That third point is getting funds into your personal name. So if you, again, depending on your structure, but if you've got a company that has a $1 million business in it, and you sell that business out of the company, that company has now got $1 million in cash sitting in it, potentially more depending on what else was in there when you sold. We've got to look at what tax is payable on that $1 million to the company. There's then a further step where we've got to figure out, okay, well, now we've got $1 million sitting in the company. How do we get that money out into your personal name with minimal tax? Okay. So yeah, there's a few extra steps to take without losing a chunk of that $1 million. Because as we know, if you pull it out, you then pay tax on that personally as a dividend. Stamp duty. So there is stamp duty on a business sale if there is an element of goodwill or an intangible part of it. So if you sell a business for $1 million, and that $1 million is only broken up between stock and plant and equipment, you don't pay duty on that. You'll pay transfer duty on the licensed equipment. So if there's vehicles and stuff in there, you pay duty on those things. But if it's only stock and plant and equipment, there's no duty. Whereas if there's 1 cent of that $1 million relates to goodwill, you pay duty on the full price. Okay, the full sale price. So it's on the $1 million. So you pay duty on your stock, on all your plant equipment and everything. Okay, so and that's an extra cost on top of the $1 million that you pay. I'm not going to profess to know the duty rates or the duty off the top of my head, but it's on $1 million, you're potentially looking at 50, 60 grand, at least for the duty on top of the purchase price. So, yeah, just be mindful of that. And again, GST. So, okay, we'll touch on it a bit later, but there's ways to structure the sale where GST won't necessarily apply. But if you can't do that, you're paying GST on the purchase price of the business. You will get that back via your BASs, but yeah, there's a timing issue there. Shares, so buying or selling shares. So as I said, there's no stamp duty on shares. So if you transfer shares from one person to another, there's no stamp duty, no matter what the component is. I lie. There's one instance where you'll pay duty on a share transfer, but 99% of the time, there's no duty. The one time where you will pay duty is where it's a land-rich company. So if there's land, so real property, in the company worth more than $2 million, I think the threshold is, you pay duty on those share transfers. Okay. GST, there's no GST. So you're not going to pay an extra 10%. You don't have to worry about BASs and so on. From a simplicity point of view, you pick up the company and you keep running. Same ABN, same bank accounts, same computer program, same everything. So yeah, you just walk in, walk out. From the con side of things, and this next point is important, is you're basically picking up every gremlin that's in that company that's ever been in that company. Okay, so you bringing it with you. There's potentially hidden skeletons that you don't know about, whether it's a unpaid bill from 5 years ago, whether it's workers' comp issues, whatever the case is, you're inheriting those. There's warranties as part of your sale. So you'll get your buyer or your seller to give you as the buyer warranties, where if anything arises that happened pre-sale or pre-settlement, they're responsible for them. But you've then still got to go through the process of, if 5 years down the track something comes up, you've got to go through the process of trying to find that buyer, trying to recover those funds off of them, so on. So just something to be aware of, and that's why that due diligence process is important. The second point there is a tax thing. So SBCGT is just an acronym for Small Business Capital Gains Tax. So these are concessions that we can potentially access, which can significantly reduce and or eliminate the tax on a business sale. Which we can do if you're selling in a business, but it's only on the goodwill component. So if you sell a business out of your structure, you pay tax on the stock, you pay tax on the plant equipment. The goodwill component we can potentially reduce by these small business capital gains tax concessions. It's a lot easier to tick the box of those concessions if you're selling the business itself than it is when you're selling the shares. It's still possible, but it's just a bit more complex. And then lastly, which I've touched on, is cleaning the balance sheet, cleaning up the balance sheet. If someone's taking your balance sheet with them, you need to make sure it's clean. Okay. Still no questions. All good. Preparing a business for sale. Okay, so this is obviously if you are a seller. These are things that you need to think about when you are potentially looking at selling the business. Okay, so 3 years profits. So this inevitably relates to how the value of the business is calculated, which it's on the next slide, but I'll go through it quickly now. So I'm jumping ahead a little bit, but really when we're identifying a business for sale, or we're looking to value a business or appraise it, slightly different processes. We generally use this capitalization of future maintainable earnings. It's a bit of a mouthful, but effectively what we're doing is we're taking 3 years worth of adjusted profits. Okay, so historical profits. So we might take, and it's often weighted. So we might take 50% of 2024's figures, 30% of 2022's figures, and 20% of 23 and 20% of 2022. To get us, and when I say adjusted, we adjusted for discretionary things. So things like donations, if the owner's paying themselves an exorbitant salary or no salary at all, we adjust it to basically get to what we think is a realistic, maintainable profit. Okay. We then apply a multiple to that, and that multiple depends on what industry you're in, depends on what sort of stage of the life cycle of the business you're in. Are you in growth or declining? What contracts you've got, what your staff is like. It's the hardest thing to come up with when valuing a business. But your safer businesses often have a higher multiple, whereas your everyday takeaway businesses that are easy to start up and easy to get going will have a lower multiple. Okay, so as you can see, the two things that dictate what the value or what we think the value of your business is in or is going to be is profits and this multiple. And that's why, going back to this slide, 3 years profits is extremely important when you're preparing for sale, because ultimately your buyer is going to look at those 3 years. So they're going to look and say, okay, well, what was the profit in 2022? What was the profit in 23? What was the profit in 24? And they're going to try and pick trends in those profits, and ultimately it's going to dictate what the value of the business is. So you want to put as much attention on those profits as you can to maximize them, so that in 3 years' time, you've got a business that has been extremely successful over the last 3 years, and that value is going to move upwards from there. Okay. The next thing, systems and processes. So again, and this is probably impacts that multiple or that return on investment figure. So if you have two businesses, one is set up Mickey Mouse, or like Mickey Mouse, where everything works, everything's got its own process, systems to follow, so that anyone can walk in, read a manual, and it's good to go, as opposed to option B, where you might be reliant on one person that knows how everything works and no one else knows. They just do what they're told to do. Obviously, business A is going to be a lot more attractive to a new owner. Okay. And so when you're preparing for sale, you want to make sure that that you are implementing and developing those systems and processes so that your business is going to be attractive to a new buyer. Okay. Employees versus owner. So this third point and the fourth point are pretty much the same. They're very similar. So what sort of reliance is placed on you as a business owner? Is everything revolved around you? Or, so in other words, you're that person that knows all the systems and processes. You're the person who runs the business and does everything, as opposed to, can you say to the employees, you just give them instructions and they know exactly what to do because they've got these systems and processes in place. Okay, so again, reducing the reliance on you as an owner, because ultimately you're going to leave when the business sells, because there won't be too many people that are keen to stick around. Okay, so work out or make yourself redundant as the owner, and gear up your employees as much as they can so the business is self-sufficient. Yeah. And then, that second last point, the state of the assets. If you look at a business, or someone looks at a business and their assets, so their plant and equipment is in disarray, hasn't been serviced for years, it's in a mess, there's parts everywhere, it's going to be less attractive to a business that all the equipment's in top notch, top state, everything works, there's service histories, all those sorts of things. So excuse me, just making sure that your assets are as good as they need to be. There's a question here from someone on the buying and selling of shares. So if as a company you would like to retain an employee by giving them some shares or potentially allowing them to buy shares, would you first need to value the business, or what could you potentially do to give them a piece of the pie in a manner of speaking? So yeah, you would. You would need to have some sort of science on it. So if you're in a business where you own 100% of the shares, so it's a company and you've got a key employee that you want to bring on and give them a piece of that pie, you can't. Well, you can transfer 5% to them for no value. So you can just give them 5% of the shares or however much. But there's a thing called, the ATO has something called market value substitution. So they recognize that, you might have a key employee that you want to reward. So you just give them those shares. But if those shares are worth $300,000 and you giving them to that employee for nothing, this market value substitution kicks in, and you effectively pay tax on the value of those shares. Okay, so where you've said can you just give them to them? Yes, you can. Or do you need a valuation? Sorry, you don't have to have one, but to recognize that market value substitution is an issue, you basically need to at least do a back of the envelope appraisal, basically to see whether it's going to be a massive issue or not because of that market value substitution. Hopefully that makes sense. I went around that a bit the wrong way. There's another one here. Is there a way to estimate the selling price of the business? For example, I have annual turnover of 10 million with a 10% profit each year. Is there a way to determine the value of the business without a comprehensive valuation? So yes, and this is where that appraisal versus valuation comes in. Okay, so a valuation is a full-blown process that we follow. Okay, so and that we have to follow. So we basically go through and look at the business itself, look at who the customers are, look at what industry you're in, and basically do a full report on the value, on what we believe the value is. So from an accounting standards point of view, there's boxes that we need to tick to do a full valuation. An appraisal, on the other hand, is I sort of referenced it before, is a simplified version, a back of the envelope valuation of the business. We're still following the same process, which is looking at adjusted profits, but there's less work involved with this multiple. Okay, so we've got a few sort of avenues where we look at what the multiple of different businesses are, but generally they will identify an industry and give you a guide on what that multiple is. Okay, so we might do one that's in retail, and this guide will give us a multiple of 5 times, 3 times, whatever it is. But that is just a guide that we use. Okay, it doesn't, and that generally looks at all retail businesses across Australia. So that appraisal is a much simplified version of a evaluation. So appraisal, we just use the guide as a multiple, whereas with evaluation, we do a lot more work in looking at your business itself to determine what that multiple is. Because what your business is doing, even though it might be in retail, would be different to what another business in Sydney or Melbourne is doing as well. So yes, you still need to do it, but it's a much simpler way of doing it. It's just an appraisal where we follow the same process, but some large assumptions. as opposed to a valuation, which is a lot more comprehensive. Yeah. I think we've gone through those. Sorry, I jumped around a little bit. Yeah. Just the last thing I want to answer. Sorry, I'm just putting those up. I just want to touch base on this. So this working capital figure here, basically. So we're finding more and more, and it's pretty much commonplace now, where if we identify the value of the business, so we take your adjusted profits and we apply a multiple, that gives us a value of the business. As I said at the start, we then break it down between your stock, plant and equipment, and goodwill. Generally now, we will find that there is an element of working capital included in that figure. Okay, so it's stock, plant, equipment, and working capital, which may mean your debtors, creditors, and so on. Cash at bank, stock. Oh, touched on stock. So there's an element of that in that business, as opposed to excess liabilities and excess assets, which might adjust your sale price. And this is more so the case when you're selling shares, where, you know, if you've got a business, if we value the business within that company and it's at $1 million, but there's $500,000 cash sitting in a term deposit that you can't get out, or that the buyer wants, they will inevitably pay you for that 500 grand. Or similarly, if there's a $500,000 loan there with a bank and they want to take over that loan, that your sale price is reduced by that liability. Okay, but generally there's an element of working capital within those figures. Okay. Next slide is due diligence. So, glass of water, sorry. So due diligence, really, as I said at the start, it's basically a process that we follow that to make sure we know what we're buying. Okay. It is optional, as I said at the top there, although we recommend it in some form or another. I often get the question from clients buying businesses, should I do it? How much do I do it? But it's really as long as a piece of string. I'll share a checklist that we use shortly, but it can take 10 minutes just to check one or two things, or it can take 10 hours and check every last little thing in the business. So really it's up to you as a buyer to think about what you were worried about in the business. Okay. It's generally more important if you're buying shares because of that hidden skeleton element, but it's important regardless. Okay, so these are the things that we review generally. I will just share this checklist here, which just gives you an idea. So, you know, we basically go through corporate governance, statutory compliance, personnel, revenue streams, customers, suppliers, property and lease issues, financial statements, and internal controls and strategic. So you can see there's a whole bunch of different things that we check and we look at. I would say the most common would be statutory compliance. So just checking ATO, making sure that it's all good, particularly if you're buying the company, because you, again, don't want to inherit a company that has 5 years of outstanding lodgements, or BASs have been lodged late, which potentially give rise to director penalty notices, or there's a debt there. So statutory compliance is common, and the financials as well. So making sure that the financials are showing what's actually correct. Okay, but as you can see, there's a whole bunch of other stuff as well. Excuse me. So corporate governance, you know, checking ASIC, checking the share registries are all sorted. We've got share certificates, the legal side of things. Statutory compliance I've been through. Personnel, employees are vital. So making sure all the employment agreements are in place. There's no workers' comp gremlins sitting around. There's health and safety systems and processes and and everything is correct in that side of things, basically. Okay, so just a few things that we look at. Revenue streams. Is the business reliant on one particular customer? So revenue streams of customer are fairly similar. So are they reliant on one customer? If so, you're carrying more risk as a buyer, because if that customer leaves, you are in trouble. Okay. Geographic areas, a whole bunch of different stuff. Suppliers, is there a risk of suppliers leaving or not giving you what you need? Properties, as I said at the start, property is vital. You don't want to buy a business that the lease is going to expire in 2 months' time. And a few other bits and pieces. Strategic stuff and internal controls are less common, but again, they're important. Probably you as a buyer need to be satisfied with that more so than us as accountants looking at it externally. Okay. So those are the sorts of things we look at with the due diligence. As I said, it is optional, and it can be as long as a piece of string. So often in the contract, we'll put that it's subject to the to a due diligence being completed to the satisfaction of the buyer. Okay, so having that to the satisfaction of the buyer in there means that the buyer can do this much or they can do this much. And do what they need to. And if through that process they identify something that they're not happy with, or that has been disclosed incorrectly, or what, they can get out of the contract. So it's important. Negotiating the sale or the purchase. I've got to get moving a little bit. Apologies. It's not too much more to go, but I'll keep going. No other questions, I don't think. So negotiating the sale, we sort of touched on this a lot throughout the webinar, I suppose. Purchase sale amount, dollar figure is the most important one, obviously. How that is split. So as I said at the start, and this is the case if you're buying the business as opposed to buying shares. If you are buying a $1 million business, generally you have to split that $1 million between plant and equipment, stock, and goodwill. As a buyer, you want as much of that purchase price put on stock and plant and equipment as you can possibly get. And that's because you get a deduction for that stock and plant and equipment, as opposed to the seller who gets taxed on that component. Okay, and a seller would want as much on goodwill as they can, because with goodwill there's concessions. So I touched on those small business capital gains tax concessions, which can effectively eliminate the tax payable on that goodwill. But even if you don't get that, depending on your structure, you'll get if you've owned that goodwill for longer than 12 months, you get a 50% discount. So as you can see, there's conflicting interests. The buyer wants more on stock and plant and equipment, whereas the seller wants more on goodwill. So it's a matter of trying to negotiate it and meet in the middle. Okay. I have seen contracts where there's a clause in the contract that basically allows the buyer and the seller to come up with their own split. So the buyer might turn around and say, well, I want more on plant and equipment and stock, whereas the seller wants more on goodwill. I've always struggled with that concept, because I can't quite envisage how one person can pay something different than another person or than the seller, but it is allowed by the ATO. The ATO does, however, have, and we go back to that market value substitution there. So if if your buyer is going and saying, right, I don't want the seller is going saying, of that $1 million, there's $0 on stock and $0 on plant equipment, it's all on goodwill. If the ATO comes and looks at it and there's actually stock that's being sold as part of the business, and there's some plant equipment as well, they're obviously going to say, well, you can't have $0 on stock and plant equipment. You've got to have something. So you've just got to, if that is the case where there's some discretion in that split, You've just got to have some reasons behind you, or some substantiation behind you as to how you got to those splits. Okay, but generally it's negotiated between the buyer and the seller, and the actual sale contract itself will say whether it's stock, plant equipment, goodwill. Okay. Conditions we've talked about. The buyer wants to put as many conditions in the contract as they can. Seller doesn't want any conditions. So yeah, it's negotiating those, and the seller's assistance is important as well. So buyer will generally, not always, but generally want the seller to stick around for a period of time after the sale, just to help get the buyer into how the business operates, do handovers, things like that. But it is, whereas sometimes they just want the seller to go away so they can do their own thing. It's not always paid. Sometimes it is. So part of the negotiation is discussing and negotiating that assistance, how long, pay rates, hours of work, all those sorts of things. So there's some element of negotiation in there. A couple of other things that we'll go through, or that we look at. So contracts and the legal side of things, very important. As you can see, there's lots of things that we think about with a business sale. Documenting those properly and protecting yourself as a buyer or the seller is vital. A couple of examples of the actual documents we do. There will be a sale agreement, or not we do, we get lawyers to do an actual sale agreement itself. So it's a business sale agreement or a share sale agreement. Leases, assigning leases, new leases, and so on. If there's an element of vendor finance, so if the seller is effectively providing finance to the buyer, providing extended payment terms, there's a vendor finance agreement. If there are, like, if you're only buying part of a business, so you've got a business that is currently owned 100% by one party and they're selling you 50% or 60% or 30%, there'll be a shareholders agreement. So it's an agreement between the shareholders of the company as to how it operates. The lawyers will look at the security side of things and the guarantees. So getting lawyers involved is vital. GST, as I said earlier, if you are buying or selling GST, the business itself, there's GST. So it's either full GST payable on the business sale. Okay, so if it's $1 million plus GST, you're paying 1.1. You've got to find an extra 100 grand. You'll get that back on your BAS from the ATO, but you're liable as a seller to pay GST, and as a buyer to pay it and then claim it back. Okay, there is, and this is important as well, there's an exemption, GST exemption, called the GST going concern, where basically if you tick all the boxes of satisfying that going concern exemption, the ATO recognize that the seller's paying the GST and the buyer is claiming the GST. So it offsets itself. So the ATO turns around and says, okay, well, if all these conditions are met and it is a going concern, it will be GST free. Okay, but there are some fairly strict conditions to meet to ensure it is a going concern. Employees, as I said, they're always vital to any business. Making sure that they are I suppose, kept in the loop somewhat, where they need to be. You as a buyer might want to meet them, make sure they're happy from day one. I've had people take them out for dinner as a welcome and all those sorts of things. Just keeping your employees happy and making sure that their contracts are done properly as well. Okay. Warranties. So this will be something that will be in the sale contract, where as a seller, you will warrant various different things to the buyer. So the most common is like an ATO or a legal warranty, where the seller is warranting or providing a warranty to the buyer that if anything was to come up after the sale, if it relates to pre-sale, it's the seller's issue, as opposed to relating post-sale where it's the buyer's issue. So having those warranties in place is vital to protect yourself as a buyer and a seller. Okay. And then that last one, look, that's a small point. Third-party notification. If you're buying a business, it's just notifying people that there's a new owner, new bank account details if that's the case. Notifying customers, suppliers, banks, ATO, and other government bodies. It's just a final thing just to dot I's, basically. As I said, it's not a huge issue, but it's worth thinking about. That's everything, I think. Hopefully I've given everyone a bit of an insight as to what we talk about and what we look at when clients are buying or selling a business. Has anyone got any questions? As I said, if you would like to talk, just probably raise your hand. But it doesn't look like there's any major things coming up. Just let me look. In a second to have a think. But yeah, as always, guys, if anyone has any questions about this, please feel free to reach out to Glenn or myself or anyone at your Byfield's office. We're always happy to help. As I said, it can be a bit of a minefield as to what you look at and what you think about. So feel free to reach out and have a chat. Hopefully I've given you guys a bit to think about and a bit of a start. But I appreciate you joining, and look forward to the next one. No more questions. Sorry, and Di, you said, can you access the recording? Yep, we will send out a copy of the recording and the slides once it's all sorted. So either, don't want to put marketing under too much pressure, but either today or tomorrow or later in the week, but you will get it at some point, definitely. So, perfect. Thanks everyone, and have a great day.